Inflation hit another 40-year high last month.
Consumer price index up 7.9%.
This morning, new inflation numbers confirming the struggle.
The evolution of inflation from the 1970s to today. In a world where the value of money seems to fade away, a silent force lurks, impacting our daily lives and financial well-being. It's the silent thief that erodes the value of your hard-earned money. It's the enemy of the saver and the investor. But what is inflation and why does it matter? We will be telling you all about it and more in this video. When the prices of everyday items go up, the value of your money goes down. Inflation affects everything from the price of groceries to the cost of a new car, and it can profoundly impact your financial well-being. Join us as we explore the hidden costs of inflation and its causes and effects. With that said, let's dive into the first question we will be answering. What is inflation? While you keep wondering, let's explore the fascinating history of inflation and how it has evolved over the years. Stay tuned and focus throughout the video till the reveal. Inflation is a phenomenon that has had a significant impact on the global economy for decades. It refers to the general increase in price of goods and services within an economy over time. The evolution of inflation can be traced back to the 1970s, when it became a major concern for many governments. Since then, various policies have been put in place to mitigate the effects of inflation and stabilize economies. Did you know that $1 in 1950 had the same buying power as $10.23 in 2017? This is inflation at work. But what really is inflation? Simply put, inflation is the increase in the cost of goods and services over time. To put it lightly, inflation is currently incredibly high. Despite our hopes, inflation shows no signs of slowing down anytime soon, and the Fed's target inflation rate of plus 2% seems like a distant dream. Can you blame them? Since 2018, we've been printing more money than ever before in American history, and it has caught up with us. We now have the responsibility of unwinding all of this free money that was given to us. There is a severe concern about a return to the inflation of the 1970s due to the rise in government spending, exploding commodity prices, and explosive money supply increase. The inflation rate in the summer of 2022 was approximately 10%, which was the highest in almost 40 years. Additionally, the memory of the nation's disastrous economic situation in the 1970s, when double-digit inflation was a problem, seems to hit a nerve, especially with investors. We know you're thinking that you are in trouble and wondering why they didn't discuss the inflation situation in 1970. Compared to now, inflation was significantly higher in the 1970s. Over the decade, it accelerated and had a tangible, stressful impact on economic policy. Due to the federal government's significant expenditures in the Great Society and the Vietnam War, prices began to rise in the middle of the 1960s. The enormous inflation increased from about 2% in the late 1600s to 12% in 1974 and 14.5% in 1980. Weak economic development causes a rise in unemployment, which eventually reaches double digits. Bingo! You cracked the answer to the earlier question. With that, let's jump into the second question. Do you know the main reason for the rise in inflation? Buckle up and get ready to learn the surprising answer as we delve deeper into this fascinating topic. Stay tuned. As you know, everything happens for a reason. So let us now focus on the fundamental causes of inflation, which are as follows. 2 oil shocks affected the nation. The price of a barrel of oil tripled during the 1973 oil embargo, then doubled once more as a result of the Iranian Revolution. When Paul Volcker was chosen to lead the Federal Reserve was given the authority to raise interest rates and slow the economy in order to contain inflation. Exploding oil prices, cruel companies, currency speculators, and reckless union officials were all accused of causing historically high inflation. However, it is obvious that the main causes were monetary policies that supported political leaders and financed sizable budget deficits. These are considered to be the main reasons for the repetition and redundancy. Some of the analogies are as follows. Supply interruptions brought on by the pandemic recession and the most recent supply chain shock brought on by the war in Ukraine, which resulted in high energy costs, are similar to oil shocks in the past. Increased government spending is causing strong demand amidst shortages of goods. Did you know? James Cook, a British explorer and cartographer, once explained the main effect of inflation by saying, "Inflation makes the wealthiest people richer and the masses poorer." Reasons for the recurrence of inflation. Factors of a structural nature. The developed world's restructuring process has reached its conclusion, and we are currently seeing a period of structurally stronger demand, which is laying the groundwork for a higher inflationary environment. However, this does not imply that there should be an unchecked inflationary period. Rather, the central banks should raise interest rates to balance supply and demand. Economic overheating. The pandemic recession's fiscal and monetary policy responses were too massive and stimulative for the world economy to absorb, so there is a labor shortage. Fortunately, the central bank can control cyclical demand by tightening monetary policy, leading to demand declines. Not only these, there are even more reasons for inflation. In conclusion, reflections from the inflation of the 1970s. Eventually, with the cost of a severe recession, smart monetary policy tightening in the past decreased inflation in significantly advanced economies and established the credibility of the financial institution. As an example, between 1976 and 1981, the US short-term interest rate nearly doubled. As demand and supply shocks go through the wage and price setting processes today, inflation is likely to stay high in the near future. However, inflation is expected to decrease in the immediate future. However, the events of the 1970s point to some real risks to this outlook. There are some indications that inflation will probably return to the desired level. As the central bank tightens monetary policy and the economic stimulus brought on by the global pandemic declines, growth will slow. Prices will stabilize as the supply shocks caused by the conflict in Ukraine are priced out. Additionally, supply issues will disappear as production processes and global logistics adjust. After decades of building confidence, expectations for inflation are expected to stay anchored for the foreseeable future. Sam Ewig, a former baseball player, once said about his daily experience with inflation, "Inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair." Hooray! You have just learned the main reason for the inflation. 2 oil shocks affected the nation. The price of a barrel of oil tripled during the 1973 oil embargo, then doubled once more as a result of the Iranian Revolution. And by the way, let's take some time to discuss the significant changes that won't come to pass as anticipated, leading to a continued rise in inflation. For instance, central banks might continue to be reluctant and accommodating in their approach. They can also fall short so frequently that investors and other economic actors start to question their dedication to and control over maintaining price stability. Inflation has been a key economic indicator studied by economists. In the 1970s, inflation was high due to oil price shocks, but it has been relatively stable in recent years thanks to central banks' efforts to control it. Despite this, inflation still poses a significant risk to economics, as seen in the recent supply chain disruptions due to the COVID-19 pandemic. Did this buzz your curiosity for more? What would you like next? Thank you for watching. Subscribe and follow for more.